Hello everyone, how's it going? Welcome to my channel where we talk about the most interesting titles in the market. In the world of investing, people are often wondering, where is the next big thing and how to accurately seize the opportunity before they take off, and how to print profit from safe and predictable income streams. It is precisely to answer those needs that the title SCHD has been created. It is an ETF that correlates with some of the world's most famous and successful brands and distributes dividends from stocks incorporated within. To a large extent, the Schwab US Dividend Equity ETF chooses the safest and the most stable industries in our economy to invest for the long term. Perhaps another reason why SCHD has always attracted so many people from the markets is because of its price action since its inception, as well as the dividend track record. Over the past 5 years, despite strong economic downside headwind, the Schwab ETF managed to increase the share price by almost 50%, which in regard of many aspects is very impressive and has beaten the prospects of many riskier counterparts on the Nasdaq. If we go back as far as 2011, when they first began trading, SCHD has increased by more than 183% since the beginning, really showing how much the stock has increased from the humble beginnings. Before today's video begins, if you'd like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent days, the exchange-traded fund, SCHD, has maintained a position around $76.13, showcasing a 4% increase compared to a month ago and 4% increase over the past 6 months. Incredibly enough, it has experienced a 14% increase from its lowest point on October the 27th, bouncing back from $67 and maintaining that level ever since. Taking a broader perspective, SCHD has been exhibiting lateral movement over the course of the year, concluding at just 1% higher than the position when this year began. Despite this, the stock has captured the market's attention, although there's a lack of compelling catalysts to propel it to higher levels. This cautious optimism is particularly noteworthy given the prevailing downward pressure on equity prices and indications of a potential economic recession. With a modest expense ratio of approximately 0.06%, SCHD offers a convenient way to hold a diversified portfolio of over 100 holdings in the US stock market, featuring well-known names like AbbVie, Texas Instruments, and Broadcom. Investors in this ETF gain exposure to key players in the American economy in a single investment. Emphasizing on its focus on dividend stocks, SCHD remains a stable choice among a period of historically high inflation, providing an attractive risk-adjusted yield of around 4%. Boasting a track record of consistency and with increasing dividends over time, SCHD stands out in comparison to other safer investment alternatives, offering more than just a competitive yield. Considering the ETF's popularity amongst both institutional and retail traders, this adds an additional layer of intrigue, especially as key interest rates are anticipated to either remain stable or to decrease in the year to come. This widespread appeal has the potential to drive a lot of upward movements in SCHD's price action. Therefore, it's recommended to keep a close watch on SCHD's price action as it maneuvers through those dynamic market conditions and to aim for an entry at some point. With that being said, here are the technicals. The trading volume of Schwab is currently around 3.9 million shares compared to the average volume of 4.2 million shares. Over the previous 52-week period, the price fluctuated between $66.67 and $78.73. The volume of shares traded tells us how many shares have been bought and sold at any given point in the time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be very easy to influence the stock price around, but hard to exit. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The assets under management of Schwab US Dividend Equity ETF is currently around $52 billion. As we compare the current price to the historical price fluctuations, the stock is 6% higher than the 1-month low, 14% higher than the 3-month low, and 14% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price can head next, the implied volatility is 11%, compared to a historical volatility of 11% as well. The put-call volume ratio is currently at 144%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent option volume is around 1.1 thousand contracts a day versus the 30-day average of 2.3 thousands. Regarding the open interest, the most recent volume of open interest is 60,000 contracts versus the 30-day average of 60,000 contracts as well. Regarding the shareholder structure, institutional shareholders own 40% of the outstanding shares. The biggest shareholders include Charles Schwab, the Bank of America, and Morgan Stanley. Typically, it's best to see some institutional presence when holding a stock long-term because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it delivers value in the long term, which is an important factor to consider for those who want to be investors. I believe that the minimum threshold should be around 30% of institutional ownership to consider long-term holding. The current short interest is around 874,000 contracts, 40% of which come from the dark pools. Typically, when the short interest is around or above 15%, we can argue for the potential of a short squeeze. However, at the current moment, there is no such rumor or there is no such phenomenon to be seen. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. In general, I would suggest a gradual position building over an extended period of time. With a potential decrease in interest rates, there could be a resurgence of confidence in an upward market trend, prompting more capital to flow back into equities for yield. However, exercising caution is very important at the current time due to the currently very elevated market price of SCHD. Despite the potential market fluctuations, SCHD might serve as a reliable stabilizing component in a long-term portfolio. It just doesn't mean that any time is an excellent time for entry. For instance, I do believe that SCHD can have some sort of a pullback in 2024. So by then, it would be highly advisable to aim for an entry point. Right now, we can slowly start to accumulate over the next few months. And I would recommend committing between 10 to 15% of your portfolio into SCHD and to split the allocation in batches of 20% to minimize your cost basis.